You know, these high interest rates, they ain't helping anybody. But sometimes when you look at the high interest rates, we can't forget about where home values are going and kind of where things are going to head in the future. So today I'm joined by a local lender, and we're going to talk about those high interest rates. Hi everybody, it's Tristan Emond with Mindful Living Realty, a realtor right here in Rapid City, South Dakota, the gateway to the Black Hills. Today I'm here with Tanner Oman of CMG Mortgage. Tanner, thanks so much for being with me here today.
Yeah, excited to be here. As we have talked about, it's the big thing right now is educating people on where everything's truly at. And so doing stuff like this is kind of the key, I feel like, to helping people out moving forward.
100%. Okay, let's all start off with kind of where things are at right now.
Yeah.
Interest rate wise, where are things at, kind of where are things going to go in the immediate future? That, I mean, obviously, we don't have a crystal ball, but from what you've heard and seen, kind of where things are at, where do you expect things to go in the next few months?
Yeah, we've actually been very lucky here recently. And I don't want to say lucky. I mean, this trend was eventually going to happen no matter what. But we're starting to see that the likelihood is we've probably hit the peak of these interest rates. It's not obviously a guarantee until we get there and look back. But from what we're seeing right now, we've had recent consumer price index reports and producer price index reports and other inflation-focused reports come out that have showed that inflation's actually been going down faster than expected.
Nice.
And that in turn leads people to believe the Fed is no longer going to have to increase the Fed funds rate. We're no longer going to have to see these increases in interest rates. And we'll eventually get to the point where the Fed's going to have to start decreasing the rates again to start speeding up the economy again. So if we have hit the peak, can't guarantee that again until we're down the road looking back. But if we have hit that peak, we should be more in the conversation of talking to people about these interest rates coming back down slowly over time, instead of talking constantly about, oh man, they could be at 8 point something next week. We might, start seeing more of the sixes be a more regular conversation piece, eventually transitioning to the fives and maybe the fours. As we ever
got that far.
Well, maybe.
I thought we never see the four again. That was my expectation, I guess.
Well, so I will say it largely is going to depend. Well, and 1,000 things can come into play, but a large piece will come into determination on if we do go into a recession or not. So if the Fed does a good job of transitioning us away from these high inflation rates, but they don't push us into a recession, it wouldn't surprise me to see these rates stay in the fives or sixes, over these next few years and go that direction. But if we do get pushed more into a recession, which a lot of economic theorists are saying that is a high likelihood. It's professionals, of course, nobody's going to get it right exactly, but in their scenario, a lot of them are saying that we are going to be hitting recession, at which point rates will probably drop farther than we think, if that does happen.
Again, so kind of it's the back and forth, come and go kind of stuff.
Yep, roller coastering as much as possible, but the Fed will keep things hopefully in fairly good control. But you never know. Obviously, they didn't do exactly the job we would have wanted during COVID and stuff either. So you never know.
Yeah. Well, I mean, 6% again sounds good compared to 8%. I mean,
yes, that's a big deal. I mean, we're talking, that with the recent stats, we're seeing that recent stat conversations were that every 1%. So this is like from Black Knight and some of the other agencies. Every 1% that interest rates drop, that can equate to about 5 million households more that can qualify for home mortgages. Gotcha. So, it helps out considerably as far as opening the door for people to be able to qualify, that we're getting pushed out a little bit with those higher rates.
Right. And with I've seen the stats too for the amount of equity that homeowners own in their home right now, that provides that much more incentive for them to sell the property if they've got more buyers, if they can move on and then also buy something that isn't a, lateral move for them of actually buying less for the same move for the same payments. So.
Yeah, exactly. Well, and you and I were talking, we did a home buying seminar just a little while ago. And the main part of that conversation was more so on what to expect with home prices. So we've had a lot of media, and we've had a lot of just, my cousin's uncle or whoever saying that they think we're going to have a housing crash or we're going to have housing values drop or so on and so forth. And, there's always going to be cyclical pieces. Usually during the winter time, less people want to buy when there's, snow on the ground. So some of those pieces will come into play to some extent. But what we're seeing is that home prices are not slowing down. there's so few houses that are available on the standard inventory, and there's less houses being built right now than what we've seen in years past, that the total inventory is really getting smaller year by year, where we still have more and more people joining that buyer's market. So obviously it's supply and demand. When you have a lot of people that can buy and will buy, you eventually are going to get to the point where if there's not enough inventory, those house prices are going to have to keep going up. So the big piece there for a lot of those individuals that do have either really good equity or just first-time buyers, if you can get something now and lock in those home prices before they go up further, that's long-term going to put you in the best spot. You can always refinance, when those rates go down, help out your payment. But if we can lock in a purchase price and save you tens of thousands of dollars on the next sale, then you're putting yourself in the best position.
Right. Now, these numbers that you're quoting are national numbers at the moment, right?
They are. Yep. Yeah. So these, most of the stuff that research is going to be based on is going to be the national statistics. Obviously, in the local area, that's where even, what I'm seeing, I'm going to rely more so on yourself and other real estate agents and the local.
And I've said this for a while. I actually don't pay a whole lot of attention to national news and national numbers because they really don't reflect what happens in our little tiny corner of the world.
Yeah.
So, even during the 2008-9 housing crisis, our numbers went down 6%. Which, compared to the rest of the country, that was nothing.
Yeah.
It was just a little dip. And then from then on, historically, we're always seeing a slow but steady increase of pricing in home value. So year to year is usually a single digit increase.
Yep.
Aside from the 2021 to 2020, that was just kind of take that on and move that away. But we're starting to see that now where we're starting to just slower uptakes here in the area. Aside from, right now, we're seeing as people kind of get used to these 8% interest rates, we're seeing this things kind of slow down as far as homes being sold, a few more concessions being made, more deals happening right now.
Yeah.
But I anticipate if the interest rates get in a reasonable, even 6s, even into the 5s, come spring, we're going to be hitting pavement pretty hard back at it.
Yeah.
Is that what you're seeing as well?
Yeah. I think this spring, so, my general conversation during that home buying seminar was that if you can buy something before the spring, that's what you should be doing.
You're going to save money because you're spending less on your purchase price.
Correct. Well,
you can theoretically...
Yeah, benefit yourself for long term. The other piece that comes into play is if these rates do slightly go down and then we have a spring buying season come where everybody's been sitting on the sideline for a year, there's going to be a lot of people entering that market to look at buying properties. And if you then have to compete against all those people, what's the likelihood that you're going to be able to get a deal on a house or pay undervalue or any of those different things? Right. Where right now, if you buy something in December, when again, people don't like closing on something when it's snowing, but you buy in December, close in January before all of these people come out of the woodwork, before interest rates go down and bring even more people into the market, you're just going to get yourself a deal. And it's kind of hard for me to not tell people, hey, you might be able to get a property for $10,000 under the value if you buy in the next month or two. Whereas if you wait till the spring, you're probably paying full price or maybe even paying a little bit over in order to beat everybody out. So if I can save you, your realtor can save you $10,000, that's a pretty big deal for just, buying in a 3-month stretch difference as far as that setup goes.
So I'll circle back a little bit to the talk about housing crash and everything's going to fall down and the prices are going to go down. What you got some research there, right, about how all that's going to happen? What do you got for us there?
Yeah, so it's what I thought and what I like to do with the clients and so on and so forth is like to give examples of where we're at as a housing market currently in comparison to what everybody fears, which is 2007 and 2008 when there was actually a housing crash.
Right.
So how do those two compare? Where are we at, and where was that market at?
Right.
And the big things that come into play when we're talking about worries that we're going to have a housing crash or worries that we're going to have housing market decline in value overall, it's really coming back to that fear of 2007, 2008. So let's compare those a little bit. And I'm, throwing out approximate numbers here because, don't have everything, right in front of me. But the big things that I like to point out in when we're comparing those years is in 2007, 2008, I'm sure you remember as well, there was a very large employment problem. We had about 10% of the individuals in the workforce actually were unemployed during that time frame, lost their jobs, so on and so forth, which is obviously 10% unemployment is very large. That's a huge negative on not only real estate, but just people in general. Yeah, it's
It's higher than average number as well, correct?
Yep, considerably higher than average, yeah. So that obviously comes into play pretty drastically. If we compare that to where we're at right now, unemployment rates currently are in the mid to high threes. So there's a dramatic difference, 10% compared to 3.5% to 4%, depending on what month we're talking about as far as looking at unemployment.
And those rates are even lower in Rapid City itself too, I think.
They are. Yep, different states obviously have dramatically different ranges that coincide.
But apples, oranges, we get that. So
yep. So national numbers, even still, there's a big difference there. And what does that actually equate to? When we're talking about home prices, what does that equate to? Number of people that can buy properties. So if we would have looked at the 10% unemployment, that would have meant that, and you can look back at the numbers during that time frame, there was about 138 million people that were employed during the 2007-2008 time frame. In comparison to today's numbers, which again will change every month, but we've jumped up to about 161 million that are employed now. So we're talking about 23 million more people employed during this current housing cycle than what was employed during 2007, 2008. So when we're having that conversation of how many buyers are there looking at properties in comparison to 2007, 2008, that's 23 million potential more buyers across the nation looking to purchase properties because they can afford housing payments, making payments, so on and so forth. So that obviously is a pretty dramatic change when you're looking at supply and demand, how many houses are available compared to how many people can buy them. We're at a considerably higher number of people that can buy properties in this current market than what we saw previously.
Which is why we're also seeing the lower inventory numbers now than we did see back in 2008.
Yeah, correct. So that's a large part of it, right? More houses have been purchased by people that can qualify for them. So that lowers the inventory available. If you look at the actual inventory numbers, there's three pieces that come into play. One's going to be how many houses are being built. The second one's how many people are actually listing their properties for sale. And then the third is going to be how many foreclosures are coming on the market that also add to the inventory. And if we compare 2007 to 2008 to now, the number of builds or new construction properties that were built in the 5 years prior to 2007 and 2008 was about 7.65 million properties that were built. If we compare that to now, the 5 years prior to what we're talking about here, it's still decent, but it's about 4.6 million houses that have been built in the 5 years prior to where we're at currently. And we're talking about 40% less houses being built in this 5 year period compared to that 5 year period. So that obviously contributes dramatically to the inventory issue as well, when you have 40% less houses being built. The second piece is how many people are trying to sell their houses during 2007, 2008, obviously largely due to people losing their jobs. There was 4 million houses for sale during that time frame for people to be able to go look at. In this current market, we're, depending on what month we're looking at, but somewhere between that 800 to a million houses.
4 times less.
So we're talking, 80% less almost houses available for sale than what we saw during 2007 and 2008, which obviously makes it.
Yeah, supply and demand right there.
Yeah.
Is ABC.
Yep.
Prices are just going to go up.
Yeah.
Into that double formula.
Yep. Pretty easy to see, those differences. And then the final one's going to be foreclosures. How many foreclosures are you seeing out there, on a regular basis? Right. Consider,
well, so basically, people that listen to land on social media, they're up 2,000%.
Yeah, exactly. Yeah.
Yeah. But I don't know how many I've seen lately. A few. Handful.
Yeah. Very, very tiny. So if you look at the actual numbers, there was about 4.6% of homeowners in foreclosure in 2007 and 2008. There's about 1.6% in foreclosure.
Which is what the whole plan was when all the lending regulations were changed in 2008. That was supposed to take care of that, and obviously has done. And then you had that on top of as I mentioned before, the amount of equity that the homeowners presently own in their properties, which I understand also part of the increase in values over 2020, 2022 especially.
Yeah.
So, but still, those two pieces kind of add up to the point where, the foreclosures coming on are going to be relatively slim.
Yeah.
And any that add to the market are going to be helpful by adding to the inventory, especially for the people, the investors that want to take them and add to rental market or take and flip.
Yep, exactly. Yeah, so and that's the big piece that we have a lot of people that are like, well, what about when, people can't afford their house payments anymore and stuff like that? Well, they can sell their house if they actually get in that issue. Luckily, not everybody, but most people are still employed. Most things are going very smooth and easy as far as making their payments, so we don't have those issues in the first place. But even still, like you mentioned, because they're in those equity positions, people don't need to go into foreclosure right now. They can just sell those properties, pay off the debts that they have, and probably make quite a bit of money on top of that. So the inventory is not going to be increasing to the same extent by foreclosures in the near future.
Really drastically weird happens.
Yeah, unless we get invaded by some, or something crazy.
Even in our area, with our trade radius.
Yep.
The hospital, always the shopping.
Yep.
Tourism, base mission.
Yep.
All the different businesses coming into town.
Yeah.
I just can't see, unless there's like a need for a big export of people from our area. I can't see our inventory going up substantially and create a huge buyer's market, and where the price will decrease it, 10, 20%.
Yeah.
Now, that's going to be different per price point. I mean, I think we're talking under $600,000. Properties, 600 plus. I could see some higher price point drops in those areas.
Yeah.
But nothing like crazy significant either, though.
So when you were talking about 2007 and 2008, we had, you said we saw about a 6% decrease in home prices, which is, during the biggest crash ever.
Yeah.
That it takes into account the $1.5 million houses, I'm assuming as well, which those properties had drastic price decreases. The average home, I'm sure, saw maybe a 1%, 2%.
All depended. I mean,
Yeah.
you saw some significant deals going on just because people are ready to sell your properties. But if you're looking at the whole scale of things, your $300,000 property went down a little bit compared to the chunk.
Yeah.
Your $1 million property went down. So I mean, there was, depending how you look at that, yes, there were price drops, but depending on the price point, depending on the severity of said drop.
I would just be interested to see, like, hey, if we looked at the 500,000 and under properties during that time frame, what was their actual drop? Because I would assume it would be quite a bit less than the 6%, that you saw with the addition of the large.
Yeah. If our average was 6%, which it was, then that would have to account for the whole gap scenario.
Yeah. So pretty interesting stuff. But yeah, it's my main, I guess, focal point is just making sure that people do understand that. I understand the media is trying to scare people. I understand that, Uncle Jim might be trying to scare people, whatever whoever you're talking to out there. But the real numbers show that we just don't have enough houses available for these house prices to decrease, because we just have too many people that need to buy, need a place to live, people moving to the area, as you mentioned, new jobs being created, all these other things. It's just,
where are we going to put it?
Where are we going to put them?
And if we don't have a place to put them, then prices are just going to go up, because that's just the way it works.
Yep.
Sorry.
Yeah. So yeah, if anybody listening can focus on getting something sooner than later, saving themselves the money, saving themselves the pain in the butt of competing against 5 people on every property they look at, that's just going to put you in a way better position. So that's my recommendations and 2 cents as far as getting through these winter months. You can get something sooner than later, then take advantage of it, because it's not going to be that much fun as a buyer once we have everybody enter back into the pool and there's still not that many houses available.
Sure. Okay, so let's talk about the different programs that one can get into.
Yeah.
Buy downs, et cetera. What are the most popular ones that you're seeing, and how do they work, and get into that information for us?
Yeah, so I mean, you still have the general, as far as like mortgage programs, you obviously still have the conventional loans and the FHA loans and the rural development loans and the VA loans and all of those standard programs, which all of them are super good programs, especially as you mentioned after the 2007, 2008 changes. They've really made all of these pieces very, very safe programs moving forward. But they do have extra tools that get used depending on what's actually happening. So one of the big things that have really popped up in the market again, which haven't been here for quite some time, I mean, they've been there, but haven't been used, is talking about interest rate buy downs in regards to having the seller, when you're negotiating with the seller, have the seller actually pay to have your interest rate be bought down. And there's multiple different directions that you can go with that. One would just be a permanent interest rate buy down. So they buy your interest rate down by 0.5% or 1% or whatever based on the credits that they provide you. And that's beneficial to the extent that qualifying ranges can improve and it still helps your monthly payment.
Sure. Yeah, because I think a lot of people are looking at that monthly payment.
Yep.
Really, unless you're, really made of cash, you're not the 30 year thing. That's just so out there that it's not something you would look at. Can I afford this month to month to month and still live comfortably? Yeah, that's, I think, the number one thing that most people are looking at the moment when it comes to purchasing a property.
Yep. And I'd agree. So the permanent, permanent buy downs, you're usually going to see, like, let's say, you go down 0.5%, 1%, whatever the scenario is, you're probably talking on average in this market, saving $120 to $220, type range on a monthly basis. So it's, and that's a permanent drop.
So say you're always at 6.5% or whatever. You have the life of the loan.
Exactly.
And you can still refinance if the rates get down to 4 or 5%.
Exactly. Yeah. So
it's all doing.
Yep. Yeah. And then again, the expectation is there, but who the heck knows? Yeah. But yes, then you have the opportunity to refinance. And again, there are lenders out there that will give you free refinances if you're purchasing during this current market. So, or, mostly for, so on and so forth. You can get deals where you're not having to pay $3,000-$4,000 for a refinance when you get to that point, because these lenders are going to kick in and help out with that if you're purchasing sooner than later. So those pieces can come into play, and you can lower your payment then even further. The second option, as far as having the seller contribute towards interest rates, is you can do what's called a temporary interest rate buy down. So the permanent one we were talking about earlier, that just puts your rate at the lower ranges or whatever lower range until you refi or sell or whatever. Mm-hmm. This one is going to have your rates go down for a temporary period. So we're talking 2 years or 3 years or 1 year, whatever you want to do as far as those setups go. And if you use these directions, the benefit is it doesn't just drop your interest rate by 0.5% for, the time frame you have the mortgage. You can have the seller cover, so the first year you're in the property, your interest rate's 3% lower than where the market is. So if, you locked in at a 6.875 type range as your normal rate, your first year interest rate would then be 3.875. And that obviously can be hundreds of dollars. We're talking $400 or $500.
But then the second year is going to go.
Yep. So the temporary aspect is that first year, if you did the 3-2-1 buy down is what I'm talking about in the scenario. The first year, your interest rate would be 3% lower. Mm-hmm. The second year, it'd go to 2% lower. And then the third year, it'd go to 1% lower, and then you just go back to your normal rate. Right. Obviously, the reason people are using this a lot more right now is, one, it's a much bigger decrease in your monthly payment. So it has a much bigger impact on your budget. Two, the likelihood, again, is you're probably going to have this mortgage for, 2 to 3 years, and then you're going to be refinancing, as long as everything goes as planned, of course. So in that scenario, if you have the first number of years at a considerably lower interest rate, and then you just refinance to a permanently lower interest rate with hopefully one of the refinance, then you're automatically positioning yourself where you never even have a 6, high 6 or low 7% interest rate. So you just get to skip all that and always have the lower payment, and continue on with that setup. So it's really nice for that temporary measure while we're waiting for rates to start decreasing back down.
Right. Yeah. Biggest issue there is just the remembering that, okay, I've gotten, and at the beginning of year 2, it's going to bump up.
Yep.
So you got to be able to be ready for that.
Yeah.
And not, I always counsel people, hey, let's not be, we're expected to see interest rates pop down, but if that second year mortgage is cutting it tight for you, that's probably not the plan for you, because if something happens and the second year pops up, here you got this bigger mortgage percentage. Next thing you know, you're being strangled.
Yeah,
maybe not the way to go for you, but it's certainly a way to start getting into something if you can save some money, build some equity up, or whatever you need to do.
Yep.
In the next few years.
And there's two pieces that go along with that I would bring up as well. if you go that direction of doing the temporary buy down with using either your money or the seller's money to buy down to those lower ranges, the lender in our disclosures and everything is going to have to give you that timetable and show you what those payments would be for each year. So you'll know ahead of time, all right, year 2 payment will be around here, year 3, and so on and so forth. So you can prep for that up front, make sure you're going to be comfortable. And the lender, obviously, the loan officer you work with should be going through that with you anyways to make sure that comfort range is set. The second piece, though, historically speaking, most people's incomes do increase as the years go along as well. So hopefully at the same time that your payment increases a little bit, you hopefully are getting your cost of living adjustments and stuff like that to also offset those changes. So for most people, it shouldn't likely be a big factor, but you still want to plan for the worst case scenario of it being a big factor. So making sure
making sure you understand how everything goes. Look at the finances of each piece. And understand also that your taxes and insurance may go up every year, which might cost a little bit more of your payment as well.
Correct.
So I just want to make sure that's. I know that's what you do, is make sure it's really clear to everybody that, hey, this is the way it's going to be. And because we don't want to get into, it's a year 2.5 and I'm screwed kind of idea.
Yeah, correct. And at no point, all these pieces are obviously, the goal of them is to make everything more affordable. So at no point do we want, anybody to move forward if at any point in this process, whether it's 2 years from now, 3 years from now, whatever the setup is, they're going to be in a position where they're not comfortable. Because eventually, let's say rates do take a while to go down, which again is not super likely, but we don't know. So let's say you are, at the end of that 3rd year and your payment's going back to that normal interest rate. We have to make sure that you're comfortable with that as the worst.
Hey, we do your pre-approval. It is at the
correct
6.85. Say we're using 6.875. You've got to be approved for that 6.875 to get that loan anyway.
Correct. Okay. Yeah, so we have to make sure you qualify for that range in the first place. And then we have the conversation also, not only qualify, but what about comfort? And then here, how those different pieces are going to look, so on and so forth. But obviously, in most situations, if you qualify for that maximum payment, you're comfortable with that maximum payment. If we can then have a number of years where you're $400 less, $200 less, so on and so forth,
in that money away or whatever you want to do.
Or just makes it that much better for you.
If you get, you feel like my wife again. If I plan things financially, it's good.
Yeah, exactly.
If you're like me, you just go out and buy toys. So.
Yeah, I mean, I wouldn't recommend that, but same thing. It's teach their own.
Living life.
Yeah, exactly. So yeah, those are the big pieces. The other things that we always talk about, because people, the other conversation isn't just payment. The other conversation is cost. Like, oh my gosh, these higher interest rates, my total costs are going to be this much higher just by owning this mortgage, this property with this mortgage. Just because you have that interest rate as your qualifying maximum rate, though, which you could, pay to some extent at some point, that doesn't mean that that's the interest you have to pay. So we always do have the conversation too of, you can pay this loan down as fast as you want to, which will, the shorter you pay that thing off, the less interest total you're going to end up paying it. I mean, you could have, your statement says you have a 6.875 interest rate, but if you pay this thing off in 10 years or whatever you end up doing, your total interest rate-wise is actually going to be like 2% or 1.5%.
If you're looking life of the loan.
So your total interest cost is a much bigger calculation in that than the interest rate. The rate doesn't necessarily matter. The total interest you're going to pay is what matters if you're looking at the cost piece.
If you're looking at the
the big picture. So there's you can do shorter terms. There's different programs that are specifically focused on helping people pay down the mortgage quicker. All those different things come into play. So if that is a worry as well, then we just have those conversations on top of making sure you're comfortable.
Right.
And
how do we get your total cost down to make you feel like you're getting a better deal or you're accomplishing your goal or whatever.
Or accumulating more wealth, in the way you want to, and so on and so forth. So there's a lot of different directions to jump into there, and that's that holistic look of your pictures is really pretty big.
Yeah, sounds good. Okay. Another thing that pops up a lot lately is assumable loans.
Yes. So assumable loans, as far as the general idea of an assumable loan is a great idea, right? So most of the time where you're going to see this come into play is going to be with VA loans. But technically you can have situations where like conventional loans say they can be assumable. It's, again, not something we really see very often. But let's say we're talking about VA just to do a little bit more standard conversation.
Because those are always.
Yeah, correct. So, there's two things that I like to bring up in particular. The first one is if you are the buyer of the property and you're trying to assume the current mortgage on there. So let's say you're buying a house at $400,000. The house is worth that, and that's what you're going to do for purchase price. And the individual has a mortgage for $290,000 on that house from back when they purchased it, 4 years, 5 years, whatever it was. That in that example, that $110,000 difference between $400,000 that it's worth now and $290,000 that's owed has to be brought in by the buyer.
Cash up front.
Exactly. So if you're not, in a position where you're comfortable bringing in $110,000 or whatever it turns out to be to cover that difference, you're not going to, want to be in a position where you're having these conversations in the first place.
But if the interest rate is 2.75% on that 190, that's owed or whatever it is. What did we say? 190 is that what we said?
I did 290 in that.
Whatever, 290, whatever it is. That payment is considerably compared to the the 6%.
Yeah.
So if you've got the 110 down anyway, and you're going to put that down on a house anyway, it might be a viable option for you.
Could be.
In that scenario.
The other thing I like to bring up, just because I know people, they understand this to a large extent in the situation because they've been in the military, they know how the government works, so on and so forth. But when we're talking about you getting approval from the VA and the lender to actually assume that mortgage that's already in place, that is not a short process. We're not, we're talking about tons of paperwork, tons of approval, so on and so forth. So we've seen a lot of these, even just talking to local title companies, I've seen a lot of these take 6 months to be able to have somebody, to have somebody be able to assume that loan.
Now, can you be a civilian to assume the VA loan?
They do have options for that. It's a bigger risk. So, now we're jumping into a conversation of if you're the one that's selling the house, if you're the military individual, the veteran that's selling your property, your risk is significantly higher if you're allowing somebody to assume whether they're military or not military. But your risk is significantly higher if you're trying to allow somebody to assume your loan in comparison to just selling your house. And there's twofold. If you're letting a military individual assume that loan, there's a little bit less risk there because you can get your entitlement back and your VA eligibility back that you had on that mortgage. If
I as a civilian buy that VA house, that entitlement stays on that house.
Correct.
They don't get it back.
Yeah. So, and I never want to guarantee any, there's always aspects, but for the most part, if a non-veteran is going to be taking that over, there's a pretty good chance that individual is going to lose their VA eligibility.
So
the entitlement that they.
So it might not make sense on a seller's side, even though it might be a tool to get sold in a stock market.
Yeah, correct. And I would say that I've even just called the VA and gone through these pieces with them as far as when is this a situation that's a good situation for somebody to use this option. And even when you talk to the VA, most of the individuals you talk to are usually going to be pretty honest with you and say, if you're going to sell your house to like a family member and you trust them, everything's good to go, they're willing to be patient for the process, all of those things, then that assumption process can be a good direction to go because they're going to get a good deal. You're likely going to have everything go smooth where you'll get your full entitlement back. Everybody's comfortable waiting 6 months to have everything get done. If you're trying to sell your house and move, let's say you're in the military, you're moving to a different base or whatever those pieces are, the likelihood of it being beneficial to go through that process is going to be very low because you, could totally derail you trying to purchase properties elsewhere if you're waiting months and months and months for this to go through. And B, you don't find out really until after the process if you receive all of your entitlement back, your VA eligibility.
The buyers have got to be eligible too, and they might think they might be, but they might actually not be, or something. And it comes along the way,
or something.
Who knows what?
Yeah, exactly. Or something can go wrong during the process, and that the VA's criteria isn't met, and they're not willing to give back that entitlement overall. So it's a big risk. Now, does that mean you can't use the VA loan again? Of course not. Does that mean you can't put yourself in a position where you may not have to put a down payment again? Of course not. It depends on each situation. But it is a risk, obviously, for you as the individual selling the property that, you could have something go awry. And
so one of those things that sounds really good, but really isn't as great when you really get to the brass tacks.
Yeah. It's dealing with government and lender pieces on the back end, all the approval, all the other, if you've been in the military, I'm sure you understand how things sometimes just, you need this much to happen, but it takes this long to get that done, even though it's something very simple. We're talking about the same thing here. It's something that should be fairly simple in theory, is not actually very simple when it comes down to it. So it can be something that's very tricky for someone to actually want to proceed with.
Right. Well, thank you for that. I've learned something new today. That's all.
Yeah.
Cool. Well, anything else that we haven't talked about that you want to mention that you've been talking with people about regularly during these times?
There's probably 200 other things that we could go through. I would just say that in general, from what we're seeing overall in any of the studies and any of the markets and any of the conversation pieces, the big thing I just want to focus on is if you have any interest in buying a property, start looking as soon as you can. Doesn't mean you have to buy something as soon as you can, but just put yourself in a position to be able to, if something pops up and you can get it before, this wave of home buyers enters back into the market, that's just going to put you in the best spot. It's going to give you the least amount of stress. It's going to give you the best price on the home. It's going to, make it so you're not, potentially having to waive home inspections or all these other things that everybody had to do back in 2020, 2021. Just put yourself in the position where you're competing against the least number of people so that you can get yourself the best deal. And that window of time is probably going to be now until, yeah, exactly. And then
tell people,
and again, if it financially doesn't make sense, I'm not pushing to have people just go buy the house. Yeah. And then have them be, not in a comfortable position. But if you are comfortable, sitting on the sidelines is going to be a much worse financial position to put yourself into. So if any way that we can help people understand that, and if they want more data, we can give them tons. So, yeah.
Yeah. We don't need to be into the bidding war scenario. In fact, I've seen that. So usually right now, the situation is if a home is on the market, it's going to sell right away, or it's going to be on the market for 30, 50, 40, 50 days, right? And the ones that I've seen that have gone right away actually have had multiple offer bidding wars.
Yeah.
So that's still around, just not as frequent. So if things kind of flip around in the spring, which I kind of anticipate things will get back to normal, we could start seeing that bidding war again. And then we're talking about over asking price offers and less concessions, getting rid of the home inspection, that kind of stuff, which I never will do, but other people has a little different idea on that. So, but it'll just get tough. And you might have a lower interest rate, but you might be paying more on your mortgage by the time the savings is done, by the time you need purchase price in. So that's kind of what I've been trying to say for a while. And I think you've said it very well, eloquently.
Good.
So thank you very much for joining me today.
Yeah, of course. Happy to do so. Obviously, any questions in the future or anything else, we can always come back and bring more data on everything we're seeing constantly. Anything we can help out with, more than happy to.
Cool. Thank you very much, Dan. Appreciate it.
Of course. Talk to you later.
All right, everybody. There you go. You heard from the man himself. Don't be afraid to watch this video and this playlist for more information about the Rapid City market and the area around here. Thanks for watching. Had an amazing day. Remember, love where you live.